Hey everyone, welcome to Nutshell Finance, your go-to spot for making finance fun and digestible. Today, I am diving headfirst into the fascinating world of short selling. You might have stumbled upon a few quick definitions online, painting it as just the flip side of going long or buying. But trust me, there's so much more to unwrap here. If you watched other videos about short selling but still have no clue of how does it work, or what risks you're getting yourself into with short selling, make sure you stick around until the end of this video because I'm going to break down the ins and outs of short selling, peppered with real-life examples to spice things up. I'm here to prove that it's not just a simple strategy it often appears to be, so buckle up and let's jump into it. Short selling, often referred to as shorting, is an investment strategy in which an investor sells an asset they do not own, typically shares of stock, with the intention of buying it back later at a lower price to make a profit. I know, most of the information you'll find online echoes the same old definitions. But hey, I'm here to shake things up a little bit. Let's ditch the jargon and step out of the virtual finance maze for a sec. Stick with me, and I'll be breaking it down into good plain English. All right, picture this. You've got a friend named Tim who has a video game that's really popular right now, but you think that the popularity of this game will decrease soon, meaning the price will take a dip too. So, you ask Tim if you can borrow the game for a short time, promising to give it back later. Tim agrees. So you borrow the game and then sell it to another friend, Alex, for $60 because that's the current price. Remember, you don't actually own the game. You just borrowed it, and you have to give it back to Tim. A few weeks pass, and just as you predicted, the game isn't as popular as it was anymore. The price drops to $40. Then you seize the moment and buy the game back at this reduced price. As promised, you return the game to Tim. In this process, you made $20 profit because you sold it to Alex for $60 and bought it back for $40. That's essentially how short selling works in the stock market. The key words here are borrow, speculation, profit from decline. It is mostly for investors who predict price drops. They don't own those shares. Instead, they borrow them and sell them while the price is high. Then they buy them back at the lower price, return them, and make a profit from the price difference. But be aware, if they guessed wrong and the price goes up, they lose money because they have to buy back the shares at a higher price than they sold them for. We're using shares as an example here, but in reality you can short various markets such as Forex, commodities, futures, bonds, options, etc., etc. Now, I bet you're wondering, where on earth can I borrow shares? This isn't a video game swap. Well, that is a good question. You need to find a middleman, a brokerage who is eligible to loan you the shares to do the trading. But just like when you borrow money from the bank to buy a house, borrowing stocks comes with interest charges as well, which is often known as margin loans. Got the basics down? Now let's spice things up with some real-life examples to showcase short selling in action. The most famous one is probably The Big Short. Michael Burry, the head of Scion Capital, was among the first to foresee the 2008 housing market crash in the US, which triggered the global financial crisis in the end. He profited hugely from shorting subprime mortgages, a story that was documented in the book and movie The Big Short. It's reported that his hedge fund, Scion Capital, made about $700 million to $800 million from the trade. Oh, a heads up. I'll be spilling the tea on what hedge funds actually do in an upcoming video, so do make sure you're following my channel because I've got some great episodes coming up. So what has happened, and why it becomes one of the most famous short-selling cases? Let's dive right in. Around 2005, Burry started noticing something odd about the US housing market. Lots of banks were giving loans to people to buy houses, and many loans required little to no down payment, even to those who didn't seem like they'd be able to pay them back. These were called subprime mortgages. At that time, everyone seemed to believe that house prices would keep going up forever, so even if someone couldn't pay back their loan, the bank could take the house back and just sell the house for even more money. But Barry thought this couldn't last forever, and that many of these loans would eventually not be repaid, which will cause a big problem in the market. To make a bet on his belief, he used something called a credit default swap, or CDS, which is like a special kind of insurance. In simple terms, he was paying a regular fee to banks, and in return, the banks promised to pay him a huge amount of money if those subprime mortgages started to crumble, which means people are not able to repay their loans. Essentially, it was a bet against the ability of people to repay their loans. At first, it seemed like Barry was wrong because the housing market kept doing well and he was just losing money on the fees he was paying for the CDS. He was under a lot of pressure as it seemed like a bad bet at that time. But he stuck to his guns because he really believed in his research and analysis. Then, around 2007, things started to change dramatically. More and more people failed to make the required payments on their loans just as he predicted. This is called default in financial terms. This also means banks don't get the money back, but ending up with lots of empty houses in their hands. Because there were so many houses suddenly available in the market and not enough people wanting to buy them, the prices of these houses went down sharply. It was a clear case of too much supply and not enough demand. As a result, the housing market crashed and numerous investment banks collapsed. Notable names include Lehman Brothers, which filed for bankruptcy, and Merrill Lynch, which was bought by Bank of America. This crash also triggered the chain reaction, a global recession. Michael Burry was one of the few who found a reason to smile because those banks had credit default swaps with him, had to pay him a ton of money as per their agreement. Barry's story is often seen as inspirational, showcasing that with enough research and conviction, it is possible to spot opportunities that the broader market is missing. Let's have a closer look. How did he short sell the housing market? Deep research and analysis. Burry spent a considerable amount of time analyzing individual mortgages that were bundled into mortgage-backed securities. Mortgage-backed securities are financial instruments that are backed by a pool of mortgages on real estate properties. These securities are then sold as investment products to investors on the secondary market. He realized that a significant percentage of these mortgages were subprime, meaning they were given to borrowers with a higher risk of defaulting. Through his analysis, he identified vulnerabilities in the housing market, particularly focusing on the indiscriminate lending practices that were prevalent at the time. Chose the unique investment instrument. When you short sell a market, there are various instruments and derivatives enable you to do that. Decide which market do you short on and what instruments do you use is the key. Instead of simply short-selling stocks of companies involved in the housing market, Burry used a financial instrument called credit default swaps to bet against the booming housing market. He approached various banks with the idea of using credit default swaps to short mortgage-backed securities, which were financial products linked to the housing market. The specific application of using them to bet against the housing market was something that he was one of the first to do on a large scale. This innovative approach to using existing financial instruments is a large part of why his actions are so noted in the history of the financial crisis. Long-term vision. Burry entered into these positions quite early, around 2005, at a time when the general market sentiment regarding the housing market was still very positive. Hardly anyone believed the US housing market could crumble. He was under a massive amount of heat from his investors, as he was leveraging their money to place those shorts. Apart from the risks he was facing, it was a high-stakes game where the entry fee kept accumulating. Remember the instrument he used to bet against the housing market. He needs to pay regular fees to those investment banks in order to hold his short position. According to the book The Big Short, that was hundreds of millions of dollars. Despite facing criticism and pressure from investors due to initial losses, Burry held on to his convictions and his positions, which ultimately proved to be correct after 2 years. After exploring a monumental success story of short selling, let's check out an instance where it did really go as planned: the GameStop short squeeze. Don't worry, I'll fill you in on what a short squeeze actually is in just a bit. But first, let's break down the events. GameStop is a video game and merchandise retailer in the US. Prior to the event, it was heavily shorted by hedge funds and institutional investors. They were betting that the company's stock price would decline due to its struggling business model in the face of digital gaming advancements. Many retail investors gathered on the subreddit called Wall Street Bets noticed the high short interest in GameStop stocks. They saw an opportunity to induce a short squeeze and began buying up shares and options in GameStop. A short squeeze is a rapid increase in the price of a stock, primarily driven by the need for short sellers to close their positions. So how does this work? Let's go back to the example that I used to explain short selling. You borrowed the game from your friend Tim, believing its popularity and price would go down. However, for some reason, the game's hotter than ever, and now everyone wants a piece of it. The price of the game starts to go up instead of going down as you predicted. Now, you're stuck because you have to return the game to your friend eventually. So, as you see the price soaring, you decide to bite the bullet to buy it back before the price goes even higher, even though it's at a higher price than what you sold it for and you're going to lose money. Now imagine if many people did the same thing as you, all trying to buy the game at the same time to return the ones they borrowed. This sudden rush of everyone trying to buy the game drives the price up even more quickly. This situation is similar to a short squeeze in the stock market, where many investors who are expecting a stock price to fall are forced to buy the stock back to minimize their losses when the price rises, which in turn pushes the price up even faster. It's a kind of chain reaction where the price gets squeezed upwards. It is believed that the first person who spotted the GameStop short squeezing opportunity is a Reddit user by the name of Keith Gill, also known by his username Deep Value on Reddit and Roaring Kitty on YouTube. Keith Gill started posting about GameStop on the subreddit in September 2019. His continual updates and deep dive analysis garnered attention and gradually created a snowball effect, encouraging other retail investors to join in and buy shares or options of GameStop. Compared to big hedge funds and institutional investors, the buying power of retail investors usually doesn't move the needle much. However, this time, they underestimated the sheer determination of these retail investors to beat the Wall Street. Citron Research, a well-known short-selling firm led by Andrew Left, announced that they had taken a short position on GameStop in January 2021 as they believed the stock is overvalued. On 20th of January, Citron tweeted that they would release a video explaining their position on GameStop and why they believed its stock price would fall to $20. In the same tweet, there is a controversial statement saying that, "We understand short interest better than you and will explain," which led to a backlash online, including coordinated attacks on Citron's social media platforms and rallied together to buy up GameStop shares and options, which caused a massive increase in the stock price. 7 days later, on the 27th of January 2021, the closing price of GameStop stock was $86.88, and it had no sign to drop. On the same day, Citron Research quitted the battle by announcing that it had closed out its short position on GameStop stock. As the movement gained momentum, the collective buying power finally led to a substantial increase in the stock price. Now, those short sellers began panicking. To mitigate losses, they have to exit their short positions like Citron Research. This means they have to buy back the stocks they initially borrowed and sold. This act of buying back the shares to close their short positions is known as covering. As a significant number of short sellers try to buy back the stocks at the same time, it creates a high demand, driving the stock price to squeeze upwards very rapidly in January 2021. Several hedge funds and institutional investors faced substantial losses due to the unprecedented surge in the stock price. For example, it was reported that the Melvin Capital had suffered a loss of 53% on its investments, and Maple Lane Capital faced a 45% loss on its portfolio in January because the short position they held on GameStop. In the end, many trading platforms had to step in to temporarily stop people from borrowing GameStop shares to take a long position because things were getting too chaotic. They worried the potential losses of those traders who were buying in GameStops will also be massive. This is because the stock price was temporarily inflated, and it did not reflect the underlying value of the company. After the short squeeze ends, the stock price will fall back to the levels that is more indicative of the company's actual value, which means the share price will fall eventually, but no one knew when will that happen. There were also several other movements targeting stocks with high short interest, aiming to create short squeezes, including stocks like AMC Entertainment. At that time, people were desperately looking for platforms to buy those stocks. The GameStop saga brought the practice of short selling and its risks into the spotlight. Short selling carries a very unique risk: unlimited losses. This is because there's no upper limit to how high the stock price can go. The higher the price, the more losses you have. This forces short sellers to buy back at potentially very high prices, as they might fear losing more money if they wait longer. In order to mitigate this risk, when people do short selling, the most common strategy is called the long-short strategy. In a nutshell, long-short strategy means when you take a short position, you also take a long position to buy assets that you think they will increase in value over time. This practice is also known as hedging, or hedging the risk. This strategy has the potential to generate positive returns or reduce losses, regardless of the overall direction of the market. If one set of assets declines in value, losses may potentially be offset by gains in the other markets. But it is rather a complex strategy than simply buying and holding assets, because usually it requires significant expertise and analysis to implement it successfully. Apart from its risks, short selling is often viewed as a controversial strategy, as it involves betting against companies and profiting from their decline. As such, short sellers can sometimes engage in or be accused of market manipulation tactics, such as spreading false rumors to drive down stock prices. In a declining market, extensive short selling can further drive down the price of stocks, potentially worsening market crashes or company failures. By now, I hope you have a clearer understanding of what is short selling and how does it work. I've only selected 2 examples to unpack the concept of short selling. There are many more interesting stories, such as George Soros's short of the British pound, Jim Chanos's short of Enron, Carson Block's short of Sino Forest, each resembling the plot of a thrilling movie. Leave a comment below to tell me which short selling events you'd like to know more, and I will boil them down for you in future videos.